Welcome to another episode of AP Macroeconomics with Mr. Molden. Today we're going to be looking at balance of payments, the wonderful world of balance of payments. Yes, you heard me right. So, the balance of payments. This goes with Forex. When you're buying and selling currency on the Forex market, you're also making transactions on the balance of payments, which is the measure of money inflows and outflows between the United States and the rest of the world. Again, like the Forex graph, it could be due any two countries, but for simplicity's sake, for today, we're going to keep it between the United States and the rest of the world. So, if you're in my class or you're taking notes at home, set up a chart. Credits on one side, debits on the other. And as we go through the three different accounts, add it to either the different transactions on those accounts, either as a credit or a debit. All right, credits are inflows. This is money coming in to the balance of payments. Outflows or debits is money going out of the balance of payments. So that's one way to keep it simple. All right. So there are three accounts that we're going to look at. All right. We're going to look at current accounts, capital or financial accounts, and then official reserves. All right. So let's just dive right in. Let's get right into it into current accounts. All right. Here we go. All right. Balance of trade net exports. When we buy things from foreign countries, right? Those are imports. Those are seen as a debit because when we pay for them, we have to pay for it in foreign currency. That means money is going out of our balance of payments. When foreigners buy our stuff, our goods are leaving, that's an export, but currency is coming in, so that is a credit on our balance of payments. All right, so this is a negative number for the United States. We have a lot more imports than exports, and this balance of trade is the exports of goods and services minus the imports of goods and services. So if you have large imports, this is going to be a negative for you. So we carry a debit on this part of the balance of payments. Next on the current account, net foreign income. This is income earned by the U.S. on foreign assets minus income paid to foreign assets that the U.S. holds. All right, so let's look at an example. All right, so let's say that somebody in the United States owns some really highly lucrative Zimbabwe bonds. Best investment ever, right? All right. So any money that that person makes off of those Zimbabwe bonds is a credit on the net foreign, on the balance of payments, right? It's a credit. Anybody that owns foreign U.S. bonds overseas and that we are paying, that is a debit. All right, so somebody that owns U.S. federal bonds in, say, Fiji, all right, they made a wise investment as well, and when the United States government pays them, they will receive dollars, all right? So the person that holds the Zimbabwe bonds will be paid in Zimbabwe currency, all right? That will be a credit on the U.S. balance payments. When we send dollars to Fiji for the person holding bonds of the U.S. government in Fiji, that will be seen as a debit. You still with me? All right, good. All right, we've made it through one down, two to go. All right, so second one, capital accounts, or financial accounts as they're sometimes called. This time we're going to be talking about the balance of capital ownership. This includes the purchase of both real and financial assets from the United States and the rest of the world. Let's dive right back in. hanging on. Okay, we got 2 down, 1 more to go. But before we get to that last one, right, we need to look at the current and capital account relationship. So in reality, these two should balance out. They don't always, right? Which is why we have the third one. The Federal Reserve helps us out and keeps the whole thing balanced. So sometimes the current account has a negative balance, right? Or a deficit. That means the capital account should have a positive or a surplus balance, and they should equal out and make it to a 0. It doesn't always happen, right? But there should be a relationship. The reason for that is that there's double bookkeeping. Every transaction really creates a capital account and a current account transaction on the balance of payments. Lucky for you, you don't have to keep track of both of those. You only have to keep track of the first one, that front side that it's easy to see. The second side, that double bookkeeping part, not really necessary to know for AP macro, but you do need to know that it exists because you do need to know that there is a relationship between the current and capital accounts, and they should equal out. So now let's dive into number 3, the official reserves. And you're done. Drink some coffee. You're going to need it. You deserve it after that. All right. So official reserves, capital financial account, current accounts. You made it. All right. Make sure you understand the difference between debits and credits, inflows and outflows of money. Make sure you know how each one of those different types of accounts has parts that are credits and have parts that are debits on the accounts as well. All right. To help you out, I've put a link to my PowerPoint in the description. At the end of that PowerPoint, after all the notes over all 3 different types of accounts, you will find some examples. All right, on the first set, figure out if it's a debit or a credit. Don't worry about what type of account. Is it a credit or a debit? That's it. All right. On the second set, then you're going to try to figure out, is it a current account, a capital account, or a official reserves transaction. All right. Once you think you have them all, there's a second link in the description that will allow you to check your notes.